Nicholas. And yeah, I just found out that I was going to be filling in for that presentation about 3 hours ago, so I'll be just as surprised as you are at what I have to say. So I'll first start, and secondly, let me say, if I were you, I would expect the real intelligence would have just finished speaking, and this is just a filler. But the idea, and maybe perhaps the value that I can add, is that of not necessarily the shipping fundamentals, and I'll cover those briefly, but more a function of what is the perception in the market, and the perception of the capital markets in particular, and what is driving optimism or pessimism, because I'm all over the world speaking to people that are investing either directly in assets or, more importantly, financing assets either through equity or debt. So, and I'll, if there's an opportunity, I'm happy to take questions as well, and I'm sure there will be, because we have a lot to talk about. But I'll first start with the container and the dry bulk market, and again, I'll try to keep my comments relatively brief, and I think they were already largely covered by Dr. Stifel. But if we could, yes. So here we are. The supply side is obviously the big issue across the board. You see the number of orders that have been placed, which is obviously down. These are all signs of bottom, right? DNB wrote off almost $1 billion worth of debt, JL, 500 million euro. You've got nearly a 50-year low in new vessel orders last year, the Hanjin bankruptcy, all things that would indicate, boy, things are really, really bad, and they are. But usually things being really, really bad is the sign that eventually things will, again, get really, really good. So with respect to dry bulk, and again, I don't want to dwell here, but similar story. You can see that orders are substantially down, as you all know. Eventually that will lead to tightening of the number of new ships relative to those that are leaving the fleet. I think one of the interesting things, and this is, I'll talk a little bit more to this, is the commodity prices. And this is really what's driving the optimism. And actually on the bottom, there's an interesting chart that shows lately the dry bulk equities have dramatically outperformed the dry bulk shipping rates. So the equity markets have all of a sudden, really in the last 6 months, become really enchanted with the idea of owning dry bulk shipping companies, even when the rates are going in the opposite direction. And there's two reasons for that. Number one, every meeting I go into, anybody that's done any work at all knows that people haven't been ordering ships in a while, and so the order book is relatively low, makes for a simple entry point. The second thing that is incentivizing people is oftentimes in the dry bulk world, investors are also fixated in other commodity classes, be it coal or iron ore or steel. And the prices of those commodities have drifted up quite a bit. And conceptually, if prices are going higher, there must be strong demand for it. So if there's a low level of supply and prices are indicative of a stronger level of demand, well, we're headed towards an inflection point, and so you should buy transportation. These are all sort of the reasons for optimism, and there's a few more that I'll talk to you in a second. But I think that is why you've seen the real increased appetite for shipping. And frankly, it's been pretty sizable. Just a few weeks ago, there was a large $50 million private placement just because. And frankly, with someone who didn't really do a lot of work on it, to be frank. Now let's talk about the bear case, if we will. So I think one of the bigger overhangs is, even though prices are really high, Chinese steel production is down. So steel prices are high, and the reason they're high is because the Chinese have been pulling back on their capacity. That's not necessarily really indicative of a stronger level of demand, as you might would think. And the same is even true of certainly of iron ore, and you can see that in the bottom slide there. In China, it's simply been a function of reducing their own domestic production and exchanging it for imports. So their actual consumption has gone down. it's hard to support really high iron ore prices when your consumption is continuing to fall. And there are differences in the quality of the iron ore that certainly make it more appetizing to import. But you run the risk that as freight rates move higher and the price of imported ore moves higher, your landed cost moves higher, you're willing to sacrifice that quality. And we've already seen some indications that the Chinese may be willing to do that. And frankly, the other big issue is that one of the areas that have been driving their steel production have been exports, and Chinese steel exports have flattened out as well. So not only are they using a little bit less domestically, but they're also not exporting as much as they were. And then there's a little chart on coal at the bottom there, where obviously we've seen a flattening of coal trade, which is not surprising. So where are the question marks? I think the question marks rely around iron ore still. It could go either way. You have certainly between Vale and Samarco and Brazil, there's going to be more capacity to produce iron ore, which will be very long haul, long ton mile demand. It's great, except that China is also sitting on the largest stockpiles of iron ore that they ever have. So if iron ore prices are really high and their inventory levels are really high, yes, there may be more iron ore coming to the market, but who's to say that they really use it? I am in the camp, certainly, that things, 2017 might not be a renaissance year as of yet. Obviously, this is a cyclical business, but I think that, frankly, the capital markets and the equity markets may be a bit ahead of themselves in terms of the timing of predicting a recovery. Now, quickly on to containers. This is another interesting case where box rates have, since May, have tripled. And again, if you are a believer that rates are indicative of a balancing supply and demand, then great. Box rates, the liners making more money, that's fantastic. Must obviously be because there's more demand. In truth, demand is a little bit higher, but it's not as much higher as you would expect. And you can see that by the fact that there's so many idle vessels still in the market. It's simply a function, and I'll touch on this in a minute, it's simply a function of better cooperation, one would call it collusion, among the liner companies that has enabled them to hold some pricing power. The capital markets have been less interested in container ships, outside of the liner companies, specifically the Europeans. But I think there's a lot of skepticism about Trump and the trade policies, and that has led people to prefer dry bulk as an investment vehicle, generally speaking. Similar story. I think the order book is bigger than it is in the dry bulk side, but still not many orders were placed last year, which is helpful. Again, and this is something that isn't any mystery to you all, we've gone from roughly 80% of global container trade being held by the top 20 players to, at the end of all of this consolidation, 80% of the global container trade being done by the top 10 players. That makes it a lot easier for people to see their way clear to holding to price rather than competing for market share. There's still a little bit to go there, but certainly that's been the trend, and I would expect in the near term that holds. And the reason that it does, if you go to the next slide at the bottom here, this is the profit margins effectively of the various liner companies. And what you'll see is the very large companies are more profitable because they're more efficient, and there are in fact economies of scale in the liner business. And so if you do consolidate, you have the ability to be more profitable, to be more efficient. And there are outliers to maybe very niche trades, but in general, especially in a weak market, if you can find a way to cut your cost as a function of consolidation and economies of scale, then you will, and they have. It's not necessarily a good thing in the immediate term for container shipping demand, because if they're more efficient, they don't need as many ships. But it is the way that it is. In the immediate future, I actually think there's likely to be a cracking of the collusion among the liners. I think that these these artificial pricing scenarios that usually hold for very long. And I would expect some of the weaker hands to begin chartering vessels to increase their market share, to push container rates up a bit, and box rates down. Would be less prone to be interested in liners, and maybe actually more prone to be interested in lessors. Again, I just grabbed a few slides for the tanker and gas carrier. This is mostly text because it's what I would use in a one-on-one conversations, and I'll fly through this because I have not prepared. Some disclosures, of course, and do the next one. And really what I want to talk about, and I'm going to throw through this, is Trump policy and sort of how people in the U.S. are thinking, how investors are thinking about what Trump's going to be doing. I think that's, as an American who talks to people all the time about this sort of thing, is maybe a unique perspective that I can give. But nonetheless, here we are, quickly on the tanker market. The problem has been that clearly, as a function of OPEC, oil production has been more than oil supply. So the oil rally that we had in tankers was artificial. It was not a function of the balanced markets. It was artificially supplied markets, and it was inevitable that it was going to roll off, and so it has. And so likewise, to the extent that oil production underwhelms consumption, it will reverse itself again. But generally, oil demand is continuing to grow by 1.3 to 1.5 million barrels a day annually, and that's going to help. It is, again, quite a few crude tanker orders last year. Not really helpful, especially given that crude tanker demand is roughly half of that in terms of growth rate is product tankers. And effectively product tankers cannibalize a little crude tanker demand. So it's a challenge there, although that market's obviously a lot bigger, and it's tough to say that they'll ever really decouple. The product tanker side, there's several drivers. Obviously, the chart that you see there is U.S. exports. They have been growing, and they will continue to grow. The U.S. is very long oil, very long refining, especially in the Gulf Coast, and it is absolutely the intention of the Trump administration to increase its hydrocarbon exports to the fullest extent possible. The other factor here is that obviously the U.S. is not the only one who likes to play that game. The Saudis and mostly anybody else who's long oil would also like to capitalize on refining margins. You see that as a function of new oil refineries that have been marginalizing refineries that are not in areas that are long oil. So the problem really on the product tanker side is not necessarily demand. Demand is, organic function has been fine, and the supply of new ships, while it has been large, is now among the smallest order books in the category. The problem has been that just globally, we're sitting on really high levels of refined product inventory, and when that's the case, nobody is forced to trade. And so you have this 10 to 15% margin of trade that goes on as a function of arbitraging and regional price differentials that don't exist when everybody has more refined products than they need. And so it will take inventories being drawn down before we really move to a more balanced market. But I think with respect to product tankers, the hurdles are the lowest in the more immediate term. LNG, obviously, growth is quite strong. The order book's large, but with all of these new wonderful projects in Brazil and Australia and Russia and Africa that are coming and will certainly have already begun to overwhelm demand, but that has driven prices lower, and so you're getting new developments everywhere. Pakistan has, in the last 4 months, has awarded 3 FSRUs. Remarkable. I mean, in some years it would be good to have 3 FSRUs in total awarded, and Pakistan in 3 months did 3. But obviously, demand and activity there is strong. I think the equity markets are pretty rich, but that investors are betting on catalysts, and at the moment there are catalysts aplenty. You see another indication of the new LNG demand that's coming online, and certainly there is new appetite in Asia. China grew their LNG imports 33%. I believe India grew theirs 28%. These countries are going to very quickly catch up to Japan and Korea in terms of their consumption of LNG. Perhaps by the end of the decade with respect to Korea. So in general, I think we're moving towards a tighter market. It's still oversupplied, but tighter this year than last, tighter next year than this, with relatively high degree of inevitability. LPG, sort of lastly, I would say to some extent this is a function of the U.S. market. The U.S. has become the 800-pound gorilla in the LPG market in terms of the exports. The challenge has been with low oil prices, the arbitrage opportunities relative to naphtha haven't really been there, but that's where the Trump administration comes in, and I'll talk to that now. And so that does it for my slides, but again, I think the interesting aspect is what is the perceived dynamics in the U.S. of what Trump is going to do. And there's a lot of wild cards, but certainly with respect to his administration and a number of shipping people, Wilbur Ross, for instance, being the Secretary of Commerce, have at least behind closed doors pretty plainly laid out what they perceive their policy to be. And they hope to improve the balance of trade in the United States. And that's done through two ways. Either you reduce your imports or you increase your exports. And the idea is to do both, actually. There's a border tax that is being pushed around, which, if enacted, would push oil prices higher in the United States relative to the international markets, which, again, pushes more, very likely would push more exports. But more importantly, what that means is if oil prices are stronger in the United States, U.S. producers are more heavily incentivized to drill because they can make more money when they do. And there are shale developments all throughout the United States, but specifically in Texas and in Pennsylvania and the Northeast of the United States, where you get all three. You get gas, NGLs, so natural gas liquids, and oil. The other big aspect of not only maybe reducing imports, but increasing exports, the one area where the Trump administration knows very well that they can increase their exports and find buyers with no problem is in hydrocarbons, because the U.S. is awash with oil and gas and can produce it at a much lower rate than most other countries in the world. So if you reduce the cost even further, if you and we've already begun to see this, if you approve pipelines, which have been done, if you reduce regulations such that drilling costs go down, if you can make drilling a barrel of oil as cheap as $25 a barrel, then you can produce an awful lot of it, because there's an awful lot of it to be produced at low enough price points. And if you're producing a lot of LNG, or a lot of natural gas, then you can export a lot of LNG. If you're producing gas and oil, you're very likely to get NGL, so propane, butane, eventually even the chemical byproducts of that, or output of that, ethylene, propylene. The market is lending itself towards a greater percentage or greater output of all of these commodities. I think you will this year see a number of new U.S. LNG export facilities go FID, as in 3 or 4 quite large facilities. I mean, those don't come online until 2021, 2022, but ultimately the U.S. is going to be the largest LNG exporter in the world, no question about it. That is certainly the intent of the Trump administration. Likewise, as oil production grows, especially funneling to the Gulf Coast, the idea is to export that oil, or even better, refine it first and then export it. I think the push is less about reducing trade or big tariffs, other than Mexico. You wouldn't want to live in Mexico right now. I think they have a very big target on them. But China and to a large extent Europe and the rest of the world are a bit too integrated, and the United States to be too aggressive. So I don't know that you can have large disruptions in trade there. You don't really need it if you're able to dramatically increase your exports of hydrocarbons, which help the balance of trade. The only other thing that I think is beginning to get traction in the United States, and I find it interesting globally, is the emission standards. Depends on where I go. There's these new low sulfur emissions. When I'm in Northern Europe, and I was just in Sweden and Norway this week, everybody believes that they will be enforced in 2020. There's no question. People are talking about ordering scrubbers. Of course, that's where they make scrubbers. And it's not a question in the least. It is what it is, and it will become. As I talk to people here in Greece, people laugh at the idea that there's going to be the actual 2020 deadline that's enforced. Is certainly, if I talk to refining companies, no question, they absolutely believe it, and they're preparing for it. So I would say that at the moment, the momentum is certainly with a full enforcement of these 2020 deadlines, which means that people are going to have to find a way to reduce their emissions. And that probably means for existing vessels buying much more expensive fuel, which probably means that diesel prices go up quite a lot as it's blended with residual fuel oil, to the tune of roughly a shifting of diesel demand of 2 to 3 million barrels per day. That's a lot of diesel demand, and the current 80% spread between high sulfur and low sulfur fuel probably widens, irrespective of what oil prices do. So it does make sense, if you believe that it's going to happen, to look into the scrubber idea, but they don't come cheaply. And again, I think the majority of the decision makers that I talk to do think this is going to be implemented and enforced. But you know, time will tell. We're still a little less than 3 years away. So that does it for me. I still have 8 minutes, so either you can be rid of me and I'll be done soon, or I'm happy if there are any questions. Specifically, if anyone is curious about what U.S. investors are thinking about, whatever. I talk to them all day long, every day. Yeah.
Thank you. One small point I want to mention is that, first of all, we are a bit short of time, irrespective of the fact that we have to be a bit more housekeeping. Since you touched on the idea and you mentioned Trump 2 or 3 times, I think, as you know, Trump has more or less come up with the idea that he may kill all the greenhouse effect is more than a hoax, and he's mentioned that on a couple of occasions. But since you came on the point of the environmental issues, I'd like to remind everybody here that the environmental issues, just to cope with them, between the years of 2015, and it's effectively predicted that there's been $500 billion. I repeat, $500 billion will have to be spent between what was started retroactive to 2015 to the year 2025. So since you are really first with the idea of the equity markets and the petty cash which we need for shipping, I think we're going to need a substantial amount of petty cash to actually cope with the environmental issues, especially the water ballast system and the sulfur reduction. Anyway, on that note, as I said, I think we can take a couple of questions, but I am a bit short of time because I wanted to call on the next session, which is a moderator with a panel. But if there are any questions in the audience, then by all means, you can take them now. Thank you. Any questions?
can repeat it if they can't hear me. How do you see West Texas trading relative to Brent crude in the next year or two?
The question was how does West Texas or West Texas Intermediate oil trade relative to Brent in the next year or two? It's entirely dependent on if the border tax is implemented. If it is, I think almost certainly it will trade at a premium to Brent. The order of magnitude, maybe it's a 10% premium. It sort of depends, I think, how quickly drilling happens and how much the U.S. can produce. And it's not quite as simple because there's not as many pipelines, say, from West Texas to Oregon that would cause that trade to be balanced, really. So it would be good, actually, for the Jones Act tankers. But nonetheless, I think if there is not a border tax that's implemented, it probably will still trade at a discount because in the Gulf Coast region, this huge amount of crude relative to the rest of the world. And so it's simple supply and demand.
Any other questions, anybody?